Okay, this is a brief overview of the three entry models that I have to offer here. There's entry model 1, entry model 2, and entry model 3. I'm going to go through this document kind of briefly explaining all three of the models. Um, I probably won't do an in-depth tutorial as I'm not really looking to, um, you know, mentor or anything. This is purely just for anybody that has any curiosity of what I'm looking at. And honestly, it's for my own personal study as well. So let's start off with entry model 1. So the logic and the theory behind it is that every day we will sweep some form of previous day liquidity. So to do so, we must either sweep meaningful liquidity such as a session high or session low, or enter an area of premium or discount before sweeping that daily liquidity. And then any other liquidity besides the session highs, the session lows, or the daily highs and daily lows will be regarded as internal liquidity. So let's quickly go over the variant 1 of the EM1. So EM1 has two variants, and I'll explain that, go in depth in a second here. So the classic variation 1, which essentially is just like a classic market maker model that incorporates a sweep of liquidity, a market structure shift, and then order blocks. So this is a very refined and well optimized entry model that incorporates only high probable scenarios. For this reason, I'm looking to sweep session liquidity and then look for a 10-minute market structure shift. And then I incorporate something that I developed called the fib strength confluence, which very logical. I haven't seen anybody else bring it up. Honestly, like it just helps me identify a market structure shift, and it saved me a lot of losses. So definitely recommend trying that out. But anyways, so first for the EM1 V1, we must sweep opposing session liquidity. So if we take a look at this this little graph that I drew up here. So market continued lower. We swept this previous session low. So in this scenario, it's like a buy scenario, right, towards the previous day high. So pretty much I'm not looking to take EM2 or EM3 until the previous day high or previous day low is met. So for the V1, we have the previous session low swept, which happens right here. Market kind of rebounds off of that area, and we have a strong 10-minute market structure shift here. And then the market retraces into an area of a discount, and we tap into a 5-minute order block, and then we trade towards the previous day high. So just a little bit of a trade breakdown from the image above again. So we sweep the previous session low right here. We identify a 10-minute swing high for a market structure shift. However, I identify the market structure shift on the 5-minute time frame, kind of using the 10-minute swing high. The reason why I do this is that because if I waited for that 10-minute candle to break, a lot of the times I would miss the move. So instead, I'm kind of like using those 10-minute swing highs and lows, but I'm waiting for it to break structure on the 5-minute. Now you may be asking like, oh, hey, what if you get faked out? Well, I don't, because I have something called the fib strength confluence. So that's something I'm going to dive into a little bit later, but it's pretty self-explanatory. I've explained it in many backtesting videos. But anyways, so I'm on the 5-minute time frame now. This is all happening on the 5-minute. 5-minute candle breaks this 10-minute market structure shift. It follows the fib strength confluence, which is pretty much like almost guaranteeing that this is not a fake out or, nothing like that. So anyways, I place my buy limit on the cleanest 5 to 15 minute order block within the discount. And then the take profit can vary on the SL size, which I'm going to dive deeper on in the video. But in most cases, the average take profit target is 3R. So now let's go through the EM1 variant 2. So I like to call it the goated variation 2 takes into account an alternative scenario to the variant 1. It considers strong premium discount arrays, which was taught originally by ICT himself, except I use kind of old session highs and lows as our meaningful PD arrays. As I've previously mentioned, any other swing highs and lows I consider to be internal. ICT has kind of mentioned stuff like this before, but anyways, I'm not going to dive too deep into it. I'm not ICT. I'm not explaining his concepts. I'm just explaining my models that I took from stuff that he taught. Anyways, so in most cases, we can use this model to trade towards our daily drawn liquidity, even if it doesn't align with our initial bias. So for this model to work, we must first sweep a session liquidity, then have a strong reaction from the session PD array, then have a strong 10-minute break of structure with a quality order block to execute from. So take a quick look at the picture here. I'll try to explain it as best as I can. So if we look at the buy model scenario, I kind of explained it here. So first, we can see the market is trending downwards. Market then sweeps this previous session high, which is a buy side liquidity. The market then returns to this previous session high, except this old swing high can now be treated as a discount array. And the way that I validate that reaction is if while we're in this range here, we got the swing low and then the swing high. While we're in this range, we retrace down to this discount array, and we don't have a market structure shift here. Instead, we're still within this range. Market breaks structure again, so we're still in the bullish scenario. And then if we have a strong break of structure, this is valid for me to take a buy entry here at an order block towards the previous day high. So formally, let me go through the buy model scenario. We failed to sweep the previous session low, which is here, which, originally we would be looking for EM1V1, but instead the market's like super trending right now to the previous day high. So we sweep the previous session high instead. We retrace back to the previous session high, except now, because it was swept already, now it's used as a discount array. The market will have a strong form of rejection and kind of break structure again. And then we have a 10-minute break of structure, which once again, we identify this break of structure using the 5-minute time frame. And there must be a strong candle body break, which I use the fib strength tool confluence. Then I can take my entry pretty much at this 5-minute order block towards the previous day high. And then again, the take profit size can vary, but the average is 3R. So now let's go to the EM2, also known as entry model 2. High probable entry model 2 is a classic turtle soup setup, originally kind of identified by ICT. I've actually updated this model today, so the win rate has actually gone up a lot for this model, which is excellent. So it's even more optimized, highly tested strategy. So for this model, we must first sweep the previous day liquidity. So essentially, I'm following an order here, right? So if if the daily liquidity hasn't been swept, I wait for EM1 to occur, or maybe I don't get an entry at EM1. I don't care. The daily liquidity gets swept. One of two scenarios is going to occur. Either market sweeps this daily high, and then we immediately have a market structure shift that's like sort of a reversal afterwards. So it happens almost immediately after sweeping the previous day high, which would be a classic turtle soup setup, right? Because we sweep buy side liquidity, and then I'm looking to take a sell afterwards towards the previous session low, which would be sell side liquidity. However, scenario 2, which also occurs, which is part of an updated EM2 that I made today, is another scenario, which I'm quickly just going to hop over to Notion, because I did, actually not Notion, let's go on Telegram. Okay, this scenario here is actually a good example. So we can see here, if you follow my cursor, make sure you're following the cursor. The previous day high was swapped a long time ago, right? We didn't have an immediate reaction. So I identified an old previous session high, right? So this is scenario B, right? Scenario A is I have an immediate reaction after sweeping the buy side liquidity, which for EM2's sake would be the previous day high. Or if the market continues to trend upwards, which in this case it did very strongly, I wait for it to sweep an old previous session high, also called a OPSH, which you can see it had a strong initial reaction there. So the OPSH gets swept. I have a 10-minute market structure shift. There's an order block identified, and then using the stop loss size rules that I have, which I will discuss, the take profit was 3R. So going back to the document here, the sell scenario, kind of more formally said, sweep the previous day high liquidity. This is for a sell model scenario, by the way. Following this photo, we sweep the previous day high in one of two scenarios. Scenario A, we have an immediate reversal after sweeping the previous day high, which is a classic turtle soup sell model. Or scenario B, market does not do scenario A, and instead the market continues to trend upwards. We sweep an old previous session high, and then we can identify the 10-minute swing low for a bearish market structure shift. Once again, I identify the market structure shift using a 10-minute swing low, but I actually look for the break to occur on the 5-minute time frame. So there also must be the strong candle body break, which, I mean, I don't really have anything drawn up here to show you, but let me see if I can find something really quickly here. Okay, let's pretend I'm looking. I don't trade Tokyo. This is just purely educational. Okay, so let's pretend this is the 10-minute swing low that needs to get swept. Actually, let's look for a real 10-minute swing low. So let's see. Okay, so here, right? So if we do a quick market replay, right, I'm just quickly showing you the Fibonacci strength tool that I have developed. Actually, this is a bad example. Those are double lows. Geez, was the market not garbage during this time? Okay, I don't want to dive like too long into this because that's not the point of this video, but let's just pretend this is the break of structure, right? The point that I'm looking for, this is like a 10-minute swing high, right? Let's pretend that this is a swing high I'm looking for a strong market structure shift. Okay, so if I go on the now I'm on the 5-minute time frame. You see, I identified a 10-minute swing. Now I'm on the 5-minute time frame. So I can see that this candle did not break structure. Instead, we created like this equal high. So this next candle did break structure. So what I'm doing is I'm drawing it from the wick low to the wick high. If the candle body, which is here, closes above these two red lines, which this is just a Fibonacci tool, 40% and 60%, those are the red lines. If the candle body in this scenario closes above the two red lines, I consider this a strong market structure shift, right? The pretty much the logic behind that is if this candle body is below, say, this red line, that pretty much tells me the candle's like a little bit indecisive, right? Because we follow the story not with wicks, it's actually through the candle bodies. Because a lot of people, the way that they would teach market structure shifts, at least in like the S&D and SMC world, is sometimes they would argue that, hey, if as long as it wicks is high, it's a market structure shift. Or Sometimes the candle body has to close above this line, but that's not always the case. So diving back to the original topic, let's continue on to the EM3 model, also known as like a daily trend continuation. This model doesn't occur too often, but it is a very high probable scenario, so definitely something worth checking out. So the logic behind this model is to follow the direction of the daily trend. Just because we swept the daily high doesn't mean we are always going to reverse. So this model kind of utilizes session PD arrays to confirm this continuation, kind of similar to what we do with the EM1 V2 variant. So a little bit of a formal trade breakdown of this image above, the image that I did draw. So we swept the previous day high liquidity here, previous day high. The market shows a willingness to go higher. So we can see we broke the previous day high. Now the market retraces without having a market structure shift, right? For EM2, retraces to our discount previous session high, which is something I already discussed in this video. So we had a strong reaction off of that discount array, had a break of structure above the previous day high, and this is a strong confluence for me to go long. Now, as far as target wise is concerned, I just go for a flat 3R. I won't touch 4R, I'll only do 3R or 2R if the stop loss is big, which I will go dive deeper further in the video. So then I can take an entry off of a 5-minute order block and then catch 3R, continuing that kind of direction. So diving into the risk analysis by economic calendar, highly manipulated news injections listed in order of severity from top to bottom. So CPI is impossible to trade with this model. That's 2 years of data, absolutely impossible to trade with this model. NFP, non-farm payrolls, cannot trade. Sometimes there are trades, sometimes there's not. I've come to the conclusion that it's just not worth trading that day. I mean, sometimes the PA sucks, sometimes it's okay, sometimes there's no entries. It's just not worth it. So I avoid NFP days. FOMC, I also do not trade as well, so I avoid that. ADP, NFE, I am okay with trading with. It's a little bit less severe than like the traditional NFP, so I'm not really too worried about that. GDP is marked as orange on my risk analysis, but it is definitely something to keep in mind. Retail sales is up there, PPI is definitely up there, Fed speakers, I mean, pretty standard stuff. In terms of risk management, exactly the plan that I'm doing right now. So with the Fivers prop firm, I'm doing a boot camp. I did an in-depth kind of analysis with the long term, and it makes sense. Long term wise, just really quickly here off topic, you'd make way more profit following this risk management plan, using their scaling plan with the boot camp. So definitely something I recommend to try. So my risk, the way I do it is I do a broad 0.25% risk based on the account balance. And then if the account is in drawdown, I do a fixed amount risk of 0.25%. So for example, let's say I had a $25,000 account. If I'm in drawdown, so I will look at 25,000. I'm like, okay, cool. What's 0.25% of 25,000? That should be $62.50. So I would be always risking $62.50. But if the account was in profit, maybe like 26,000, I would do 0.25% risk based off of whatever the balance is. So not like a fixed amount. So crucial stop loss rules for the entry models. So I only trade two instruments, S&P 500, also known as ES, because I trade with the futures contracts. The stop loss must not exceed 70 ticks. Quickly, just to show you what I mean by ticks. So I'm just drawing up this quick take profit thing here. So ticks, what does that mean? So this number in the middle here, we can see the number is 9. That's what we are calling ticks here. So 70 ticks would be pretty large. I feel like that's kind of obvious. You don't want to trade 70 ticks, especially on ES. So I don't trade 70 ticks on ES. NASDAQ, it's like 200. If you compare the two, but like size, they're relatively like 200 ticks and 70 ticks. Comparing NASDAQ to ES is somewhat similar in size. And that's really just from my own back testing as well. So the stop loss must not be over 70 ticks. If it is, the trade's invalid. NASDAQ, if the stop loss is above 200 ticks, the trade's invalid. Take profit rules. So the take profit is not targeting, certain liquidity points. I don't do it that way. Instead, I just have set take profits based on the stop loss size. So traditionally, I would always use a 3R take profit. However, once the stop loss started to get a little bit big, I noticed that the market started to die down a lot. But if I was in the sweet spot, 3R, almost always I would have a strong reaction off the order block. I would hit 3R and then the market would almost immediately retrace. So I started to notice a pattern, and I figured that a lot of it has to do with the stop loss size. So for ES or S&P 500, if the stop loss size is below 25 ticks, it is safe to take a 4R take profit. If the stop loss size is below 50 ticks, but above 25 ticks, the take profit is 3R. And if the stop loss size is above 50 ticks, but not above 70, we would take 2R. Now, you don't have to take the 4R. The 3R is an incredibly safe number, but this is just from my own recent testing. But 3R is traditionally what I'm known for. NASDAQ or NQ futures, if it's below 70 ticks, safe to take 4R. Below 100 but above 70, 3R. If it's above 100 ticks but not exceeding 200, you want to take 2R. Now, risk management by probability. Now, both pairs, ES and NQ, or S&P and NASDAQ, must have an aligned bias. And we must sweep the daily targets on both assets before even considering an EM2 or EM3 model. What does that mean? Sometimes I'll hop on the charts. We swept the previous day high on ES, but maybe NASDAQ's a little behind. We still haven't swept it. Traditionally, if I see that the daily liquidity swept, I would immediately start looking for an EM3 or an EM2. But I'm not even going to consider any of those models until the daily targets are met on both pairs or assets. So that's very crucial, very important note. I'm only trading the same direction for both assets. If the drawn liquidity looks off and looks different and opposing, that is not a day I'm interested in trading. Go ahead, check ICT's Twitter. He's mentioned stuff like that many times. He's like, oh, the biases look different. Just today, actually, September the 21st, 2023, he was mentioning something with Dow and NASDAQ, ES, all looking different. So, we definitely want to listen to this guy. Bias must be aligned. Economic news rules, kind of a little bit going back to what I mentioned already, but very important. Never trade CPI days. NFP days, never trade. That does not include ADP, NFE. It has to be just NFE, also known as NFP. FOMC days, rarely do our models play well, so I just decided to not trade it. I don't care. It's one day, guys. Like, could care less. News buffer. I should have highlighted this because it's probably the most important part. If you haven't watched the backtesting, the news buffer, essentially what I do is any orange and red news that aren't any of these three, I'll leave a 10 to 15 minute buffer between the news events. So what that looks like is, say I have like, I don't know, what's a good example? Existing home sales at 8:30 a.m., right? Eastern, which is a very common time for that to occur. We know it starts at 8:30. So essentially between 8:20, which is a 10-minute buffer before, and 8:40, a 10-minute buffer after, between that time from 8:20 to 8:40, I'm not going to be executing any trades. Even if there's an opportunity presenting itself, my entry either has to occur before the news buffer or after the news buffer. If not, it's completely invalid. I'm not taking it. Daily liquidity. If the daily liquidity is swept pre-market and is heavily one-sided, look for the Tokyo London reversal towards the Asian liquidity. This happens a lot. Political speeches. Never trade when Biden or Powell speaks. That means the rest of the session. So if President Biden or FOMC member Powell speaks in the PM session, pretty much means I'm just going to be trading in the AM session. A lot of the times these two guys, they just move the markets way too much, which that's not a good thing, because then that just doesn't leave any room for us to look for entries. In terms of chart setup, I primarily use the 12-minute to draw up my liquidity, the 10-minute to identify my swing highs and lows for structure changes, and then the 5-minute time frame for order blocks. But some of the other time frames I use is the 8-minute. 8 minutes really nice to kind of confirm the strength of 5-minute order blocks, I've noticed. And the 15-minute as well is good to kind of validate if the 8-minute order blocks are good. And then in terms of indicators, FEG, Nephew Sam, sometimes I use market session, but Waffle House, which is the indicators that you saw there. I mean, it's really just an edit of another market session indicator, but I just adjusted it to our timing. You can look up another market session. It's literally the same indicator, but the buy Waffle House version is just like a updated version with our unique times. And then I have another indicator which is used to identify the daily open and close, which you just hop on the chart here, going a 12-minute time frame. You can see that I use these red blocks. So pretty much from this red block to this red block, this is 1 day, and then kind of just same goes for this red block and this red block. I don't know. It's useful for me. So 15 minutes, higher high, lower low, charged by E-man, and then optional ICT, NWOG, NDOG, which is nice little confluence sometimes. In terms of daily processes, I always review the news before I even log into TradingView. Want to avoid these 3 red news days. Then I want to move on to step 2. Has daily liquidity been swept yet? If not, look for the EM1 variance. If it has, proceed to EM2 automatically. However, if the daily liquidity was just swept, look for EM2 or EM3, right? EM3 only works if the previous day high or low was just swept. And we had a strong PD rate reaction shortly after sweeping the daily liquidity. In terms of win rate, collectively, if we take a look at all of these models put together, actually this is an outdated win rate. The win rate's actually 88%. I just forgot to update the document, but collectively from 2022 to 2023, EM1, EM2, and EM3 have a win rate of about 88%. In 2023, EM1 had a win rate of 94.74%. EM2 had a win rate of 81.25%, and EM3 100%. Now, With that being said, EM3 did only have 8 trades within the year. So for that reason, this is not really a safe number to be using. It's more likely within these two ranges here. As you can see, the average is about 80. Well, it is 88%, but regardless, we can see it's an 80% win rate overall. So with that said, total trades 63. EM1 occurs only 30% of the time. EM2 occurs 57% of the time, and then EM3 only occurs 12% of the time. Taking a quick look at what they look like. Here's an example of EM1. This is a EM1 V1, kind of taking our theory into practice. We sweep the previous session low, create a 10-minute swing high, have a strong market structure shift, market returns to an order block, and we trade towards the previous day high. Here's a EM1 V2. Market, instead of sweeping the previous session low for a EM1 V1, market instead sweeps a previous session high, returns, has a strong reaction, breaks breaks the structure, 5-minute order block execution, trade towards the previous day high. Take a look at EM2. EM2, sweep the previous day low. Actually, let me show you one of the updated ones, because that I have not done. Oh, here. Okay, this is a good example. So, market sweeps the previous day high. We don't have a quick reaction as a reversal, so market instead kind of keeps trending up. We sweep an old previous session high, which falls for scenario B for the EM2. Have a reaction, have a 10-minute bearish market structure shift, enter on a 5-minute order block for 3R. And then if we take a quick look at EM3, which I'm gonna have to find because, like I said, it doesn't happen too often. Let's see. Perfect. Okay. Market breaks the previous day low. The previous day low was, for this trade, at least I remember, was also a double low for a previous session low. That's why I say previous day low and previous session low. So market sweeps both of that. Market returns to an area of a premium. Market has a strong reaction and has a 10-minute break of structure. And then we can take an entry off this 5-minute order block, and then you can see very strong reaction. So this is an overview of pretty much all of the WHI entry models, kind of the trading plan, the daily processes, and then the current data for 2023 and collective data of 2022 to 2023. So yeah, that's pretty much it.